Okay, good afternoon, everyone. My name is Bill Levinson, Managing Partner with Levinson and Associates. With me today, we have our Joseph Lochran, Marketing Vice President here at Levinson. And then we have our special guest speaker, okay? He is very well known in the industry. He's also our VP at John Hancock. And Andrew's here to talk about premium finance, Hancock's new IUL that is simply a game changer in the industry, okay? So you're going to learn about some new bullets around IUL and premium finance. We're going to learn a little bit about John Hancock and what makes them unique, okay? Hopefully this will take your practice to the next level, okay? I always feel that these weekly trainings, in fact, this week, this is our second live webinar, but the goal is that every webinar that we host, that you walk away with one little nugget of information that will help change the way that you do business, okay? And in my opinion, if you can spend, 45 minutes with us and learn something new, it's a win-win. I would take down notes so you don't forget anything that you're about to learn. And also, we'll send a thank you email out to all participants, and we'll include any relevant brochures, illustrations, of course, Hancock licensing, so we can make sure that you are up and running and ready to sell. If you are currently appointed with John Hancock and you want to come under Levinson to take advantage of all of our tools and platforms, just let us know. We have a cash for contracting incentive where with your first step, you'll get anywhere between $100 to $400 cash, and we'll, of course, match or beat your existing grid. So if you're interested in that, of course, let us know as well. We'll include the link in the thank you email. Any questions, feedback, comments, good, bad, indifferent, we want to know, okay? So please don't hesitate to reach out to us. If we need to, we can, of course, get Andrew on a call, or if we need to reach out to him for you, we can do that. But make sure you reach out to us, and 99% of the time we have most of the answers regardless. But again, if we need to get the home office involved, we can do that for you. Okay, so I'm just going to talk about a few things, and then we're going to introduce our feature presenter. Just real quick, I'm going to talk about IUL for a second. And obviously, we have 67 carriers. We have all of the top IUL carriers. Hancock rated A+ by AM Best. They stand out, okay? And with this new product, you're going to hear about some great bullets that no one else has, okay? So I think that this definitely fills a gap in the market. But yes, we do have all of the top carriers and products, and I'm a big believer in IUL and, of course, the S&P 500. And I was just listening to an audio book last week, and they brought up, it was actually back in 2007 when Warren Buffett made a bet, okay, and he said that I will bet an unmanaged S&P 500 index fund will outperform a collection of the top 5 hedge funds, okay, in the country. And long story short, Warren Buffett won the bet, okay? And the S&P 500 outperformed the top indexed hedge funds in the world. And that just goes to show us, especially if you're a young professional, if you have plenty of time to invest and put a few $100 a month away at the minimum, and there's no better product, okay? IUL is a win-win, and what Hancock brings to the table is a win-win-win, and you're about to witness this. I'm not just saying it because Andrew's on the phone with us, but I think that by the time we're done with today's presentation, you'll agree. We also put together some great prospecting material. We have Iul Software that will show you what I was just talking about, how the S&P outperformed these top 5 hedge funds. So this software will actually show you what an IUL looks like, and you can upload the Hancock IUL info. It will show you how that looks against any retirement product, any type of bonds, any Roth IRA, any investment product on the shelf you can compare against IUL, and it will show you how IUL is a clear-cut winner when it comes to tax advantages and death benefits and withdrawals. It's a clear-cut, black and white scenario, and now it's up to you to sit down with your prospect to explain this. So our software does exactly that. And if you're writing IUL premium, it's free. We also have a great IUL book that we've helped put together. And this book, it's literally $5. It's a co-op price. Now, the way this works is you hand this out to prospects, and it literally sets the appointment for you. It's a very easy 30-minute read, layman's terms. You hand this out to a prospect. By the time they're done reading it, they say, Bill, I'm ready to make an appointment and sit down with you to talk about IUL. Okay, so it literally is handing you a live lead on the table. So these books are available. We're going to go over that in just a few more minutes here, but we have some great stuff that you can take advantage of and leverage the Levinson resources that we've put together for you. Okay, moving forward real quick, speaking of technology, yes, this includes our awesome IUL presentation software, okay, that you can load any IUL product into. So this is the cover of Insurance Newsnet magazine for August, and we were featured, and I'm very, very proud of this. And no, I'm not training for a boxing circuit here. This is all about industry innovation, okay, and how Levinson every single year is coming out with new technology and new platforms, and how we're changing the game in the independent agent space. And I feel that we're doing just that, okay? It always feels good to be noticed from a third party, separate from Levinson. So I'm also going to say I'm very humbled by this article, and we would never be in this situation, okay, if it wasn't for our 15,000 agents out there in the field. So my hat goes off to you, okay, because we would never be in this spot, ever, okay, if it wasn't for you all that believed in us every step of the way, okay? We started with literally 150 agents. Today, almost 15,000 in every city in the U.S. That article will be included in your thank you email, and I encourage everybody to read it. It talks all about the latest technology and how we are taking technology and incorporating that into this old school brokerage world and changing the way agents do sell and market in the life insurance space. Okay, moving forward, Agency Automator. Speaking of our innovative technology, okay, so this was created by Levinson for insurance agents. In the top left area there, that is the iGenius Agency Automator. That's our value add platform that we put together for life insurance and annuity agents. The main circle there says Agency Automator, and then you will see those 5 little circles coming out of it. I call them legs. Just real quick, all of these components make up Agency Automator. So the first little circle there, it says CRM. It's about 9 o'clock on going clockwise. CRM tool. Now, the website builder and CRM tool is free for all active Levinson agents. So you can go set up your website, you can create your template. We have live lead capture, and we have various quote engines, we have calculators, we have an annuity quote engine, articles, I mean, all the above. It's a free website, turnkey. And then you get a free CRM tool that is built to keep your name in front of your clients and prospects. We have a bunch of marketing material that you can drag and drop and co-brand and blast out to your clients and prospects. All of that is free. There's a $9 a month hosting charge, $9.95, and everything else we take care of. Then moving forward about 12 o'clock on that wheel, Agency Automator Plus, that's used to recruit new agents. We literally have a database of over 500,000 licensed agents in the country that you can go out and market to build your own hierarchy. Moving forward there about 2 o'clock p.m., going again clockwise, we have our virtual assistant. This is a live person that will call all of your clients and leads and prospects and set up seminars and webinars and appointments for you. Even reach out to your clients just to say happy birthday, or hey, it's been 9 years that you bought your 10-year term. Are you willing to speak about a new quote, or maybe converting your term policy? You know, whatever the case is, this is your live assistant. Okay, that's the virtual assistant. It's a co-op program. It's like pennies on the dollar. So there's no need to not move forward with a platform like this. Moving forward there, about 3 o'clock is AsureWorks. That is our brand new target marketing tool we just launched yesterday. If you didn't see that webinar, let us know. We will email it out to you. But long story short, that's a game changer, folks. I mean, if you've been online lately, which I know all of you have, okay, if you went online and you looked at a new Chevy Corvette, okay, and you built a red Chevy Corvette with black leather interior, and then if you notice the following evening or the next day, you check the ESPN basketball scores, and next thing you know, you see that same red Corvette in the bottom left corner, and you scratch your head and you say, whoa, my God, how did Chevy or GM know that I was on ESPN and they're showing the same car that I built? This is crazy. Maybe this is meant to be, right? And if you still don't buy the red Corvette the next week, okay, in fact, for the next 30 days, everywhere you go on Google or a chat room or agent forum or whatever the case is, the red Corvette keeps following you around town, right? Online. This could be from your smartphone, from your desktop. This is the same platform that we have built, but for life insurance agents. So any prospects that go online and they pull up an insurance article or investment or long-term care or IUL, okay, S&P 500, whatever the case is, next thing you know, if they're in your zip code that you choose, guess what? Your ad is going to follow that prospect everywhere they go for 30 days until they make an appointment with you and purchase a product. Okay, it is freaking awesome. And again, co-op platform only available through Levinson. Folks, this is a game changer, okay? And I'm not just saying this, we don't make any money on this stuff. In fact, it costs us money when you participate, but this is part of our whole value add and what makes Levinson unique. So I hope you're excited. I hope you're sharing this information with your downline, because this is going to help attract agents to you as well, okay, which is a win-win-win once again. So just be thinking that as we go here. Okay, moving forward, we're talking all about IUL today. That IUL software that we have put together is an awesome, awesome platform. If you're writing IUL, this is free for you. Once again, we're having a live demo on the 23rd. I'll be hosting this with Joe and our program director. So that's August 23rd, 2 p.m. Eastern time. Make sure you're on this training. It's about 45 minutes. We give you all of the material you need for seminars, webinars, one-on-one appointments. We show you how to build an IUL presentation in minutes, okay? So you can be ready to sit down with a client and propose IUL, and to make sure that you know what you're talking about and you sound halfway intelligent so you can answer some questions all about IUL. So we gear you up so you can become an IUL sales professional. Make sure you're on that call, 823. Okay, our last slide here before I introduce Andrew is the IUL sales book. So this is the new rules of retirement savings. It's a co-op $5 fee. Okay, on Amazon, these are $19.95 retail. Again, Levinson agent, you pay $5. Give these out to prospects, and it generates the appointment for you. I promise you. Okay, in fact, if you're appointed with us with an IUL carrier, okay, I would like it to be Hancock, and you're on this call today, just shoot me an email, and I will send you out a free copy. That's how confident I am that you're going to love this book, especially holiday time, birthdays. Give this out for free to your prospects, and it will set the appointment for you. Okay, moving forward here without further ado, I know I start ranting a little bit. So we have Andrew Spiro here, who I've known for many, many years now. He's our VP with John Hancock. He's a true marketing professional. Andrew, you there?
I'm here. Can you hear me well, Bill?
Yep, loud and clear.
Perfect. Okay, should I take it over?
Yep, you're good to go.
All right. First of all, thank you for the warm introduction, Bill. You're super professional. You have a great organization. You create a tremendous amount of excitement, and you look pretty good in that beard. So really happy to be part of this call. Super excited, candidly. Bill used the word game changer. I'm not sure where he came up with that, but it is. Our new product is a game changer. I rarely do presentations on a product. I usually talk more about concepts, as Bill knows. But this product is so good. I have to say it's the first product that I actually have placed on myself in quite some time. It's that exciting. So without further ado, let's just get into this thing. The new Iul 18 product. This just shows a competitive landscape and how the product is priced super well, but let's get to the heart of the matter right away, Bill. Let's not mess around. This product demands immediate attention to get to the guts. The big thing with this account is with this new product is better multipliers and a brand new high capped account. And that high capped account is going to produce the highest, as far as I'm aware, the highest potential returns in any given year. You can essentially get up to an 18.9% return, Bill, in any given year with a floor of 0. If that doesn't get you out of bed in the morning, I don't know what will. To be able to have access to a policy that you are protected on the downside, but you can get returns as high as almost 19%, to me, that's super exciting. And the way we get there is the multipliers. So let's talk a little bit about how well the product performs, and let's get into the guts of the product. And I'm going to go through this quick because we got a lot to cover. We're going to talk at the end about premium financing, because this is a wonderful product for not only retirement income, but also for premium financing and any kind of alternative investment strategy ideas. So the most important thing with an index product is we know we're not going to get a linear return. When I see a 6% illustration, a 5%, 7%, the one thing I can guarantee is that will never hold up. It might be better, it might be worse, but we're definitely not going to get a 6% linear return. I use the line, and Bill always gets a chuckle when I mention this to him. I said, the only thing illustrations prove is that ink sticks to paper. So what this slide shows, I think this is a critical slide, is that our product was designed to perform well, even if the market doesn't. And when you're talking about the index product, the number one reason people buy the index product is to protect themselves from the downside. That is the most important reason why people buy it. So if we look at this chart, we look at Pac Life, Nationwide, Minnesota, Allianz, and Symetra. These are some of the leaders right now in the index space. So we see that if we have a male 45, we're going to do the max AG 49 rate, which vary based on each company, based on your floor and your cap. And we're going to do a 5-pay design with max income for 20 years, starting at age 66. If we use the max rate, we're right there at number 1, slightly edging Pac Life. But if we drop it to 6%, we still are right there, unlike, say, Minnesota, which really falls off the map. And if we drop it down to 4%, you're going to see an interesting trend here. You're going to see that our income obviously drops significantly, as it should, right? You went from essentially, a max rate of 6.21 all the way down to 4%. But you'll see that Pac Life, Nation, Minnesota, Allianz, and Symetra all fall off the chart. Now, why do they fall off the chart? Because of their loading and their COI charges. So it's very important, in my opinion, if you're going to be selling an index product, we want to make sure that's going to perform well regardless of market performance. Okay, now let's take a look at a history I think that speaks for itself. This is the look back period for our index product, and we're looking back 10, 20, 25, 30, and 40 years. When I run the index products, people sometimes they don't know what to run, and so they'll run a flat 6%. Sometimes they'll run the max AG 49 rates. Sometimes they'll want to be conservative, and they'll say, well, show me a point less than what the max rates are, or show me 5%. Well, this chart to me was actually eye-opening, and I was shocked at how consistent the returns have been over the years. I would define a market cycle, or market cycle is defined as a 10-year period. So if you're able to hold this policy for at least 10 years, look at the returns. Based on our current floor and caps, you'll see that for 10, 20, 25, 30, and 40 years, how consistent the returns have been. If we look at the capped account, you're looking at 6.47, 6.46 over 20 years, 25-year look back 6.73, 30-year look back 6.75, 40-year look back 6.72. You go to the high cap index account, and it's roughly the same story, just with 8% returns. The point of this slide is, if you want to stress test the product, fine. But showing the product at 3% or 2.5%, which is what the caps can be reduced to, that seems a little bit egregious, right? It doesn't seem realistic. And I think most people, when they see this, and this is a consumer-approved piece that we can provide, we'll get it to Bill, that I think your clients actually are very comfortable when they see how steady the returns have been. And that's because we know with an index product, it's like walking up a stair. You're either flat or you're heading up. You never go back. And by not going backwards, you have these smooth, steady returns. Okay. The other thing that's important, I think, in a fixed account, in a index product, is to have a safe harbor. And the safe harbor for a index account is the fixed account. And we have one of the best in the industry. So if for whatever reason option pricing goes wonky, the market goes wonky for any reason, the safe harbor is being able to move your money into a fixed account. Our fixed account is among the highest current crediting rate in the industry at 4.2. And here's the secret sauce. We don't charge, Bill, the same loads in our fixed account that we do in our index choices. Why should you? You're not getting an extra multiplier. You're not getting returns as high as 19%. You don't have that extra turbo engine, so you shouldn't pay for something that you don't have access to in the fixed account. Pac Life and most of the other companies on the sheet, they charge you the same loads and structure in the fixed account. By doing that, it prevents it from becoming a safe harbor, and so there's really no place to go. So if you see in this design, if we show 100% allocated to our high cap account that has a cap of 14.5, that's our new account with a floor of 0. We dominate from an income standpoint. The only one's closed is Pac. But if we decide to allocate 100% to our fixed account, which is 4.2, no one can come close to our numbers either. And that's because we don't have that additional loads in the fixed account. So this is a well thought out product to protect you, make selling it easier, and to protect your client. The other nice thing that we offer is we have a suite of living benefits. Bill talks about that all the time. I think him and his firm do a phenomenal job of really talking about, hey, what's in it for you? I always make the joke that people love their children, their churches, their synagogues, their charities, but they love themselves a little bit more. So to be able to offer, living benefits to benefit them is a big deal. So we have a critical illness benefit rider that you can add to our index product. We have a long-term care rider, and we have a vitality rider. I'm just going to take a step back and discuss each very briefly. The critical illness benefit rider, we have a 10% or 20%, 25% of face amount option. So if you have $1 million contract at 10%, it would be an extra $100,000. At 25%, it would be an extra $250,000. $250,000, by the way, is the max that will pay out above and beyond the death benefit in a lump sum if your client gets diagnosed with a critical illness, cancer, coronary disease, stroke, etc. We define 7 critical illnesses. The money is tax-free. It's above and beyond, doesn't impact the policy whatsoever, and the clients can spend and use that money any way they want. If you're not familiar with the rider, I would definitely look into it. It increases your cost by 10% roughly for the 10% rider and about 20% for the 25% rider. The long-term care rider, we have among the least expensive LTC rider in the industry. It's qualified. The rates are fully guaranteed. The additional cost is generally an extra 7 to 9%. And it's a reimbursement, so it reduces the death benefit dollar for dollar to reimburse for LTC needs. Probably the most competitively priced rider in the industry. We're not subject to the IRS limits because it's reimbursement. Again, very low cost, and the rates, the formula for the LTC is fully guaranteed even if the product is not, which is a very important distinguishing feature of it. And then, of course, we all know about our Vitality Rider, which gives clients control to a certain degree over their mortality, over their premium payments. They get a COI discount for engaging with us, and we make it very easy to engage. So it puts them in the driver's seat, allows them to achieve greater income or a lower premium, and rewards them for ultimately living a healthy life, which is going to extend their lives. And if you sell Vitality, and I'm sure everyone on the phone is aware of this, John Hancock is now offering an extra 10 points, an extra 10% if you add Vitality to any permanent sale. So if your target premium is $100,000 and you add Vitality, you will get 30 days after the placement of the sale an extra $10,000 in a brown paper bag with unmarked bills, with Bill coming in that boxing gear. He'll drop that off at your home, but seriously, you will get an extra $10,000 30 days after the placement of the policy if you add Vitality, an extra 10% bonus, which is been well received to say the least. Okay, let's get back to the product now. Here's the secret sauce of the product. We have multipliers that allow your clients to exceed the cap and get phenomenal returns and upside. The multipliers are contractually guaranteed. This is very important. Most of the companies out there, their multipliers are not guaranteed. And two, the multipliers start in year one. Most companies that have multipliers, sometimes they call them bonuses. Some start in year 3. Some start in year 5. There's a company, I don't want to name Pac Life, that had a policy called Veriflex that was supposed to have a multiplier that wasn't guaranteed start in year 3. It didn't. They never paid it out. Ours are contractually guaranteed. They can't change. They start in year 1. So what are our multipliers? Well, our multipliers, if you can see, are significant. So for the capped account, the guarantee multiplier is 55%. So let me explain how this works and why this is so powerful and why this is the secret sauce. So if the S&P should return 10, you'll see our cap is 10.25. So if the S&P returns 10, if you're in the capped account, your client would get a 10% return. We would then add the multiplier on top of it. So instead of getting 10, they would get another 55% of the 10, which would give them 15.55%. If the S&P did 15, they would get 10.25. We would add the 55% multiplier on top of that. They would get 15.89%. If you can go to your clients and tell them that there's a product out there that if the S&P returns 6, they're going to get 9 contractually, and they'll never pay tax on the growth and the distribution of that money again, and it's asset protected in most states, again, that gets my blood flowing. For the high cap, if we're going to go to the bottom, we have a maximum rate of 7.88% based on our high cap of 14.5. This account has a 30% multiplier. So again, just to do the same math, if the S&P were to return 10, you would get 10 plus a 30, which would be 13%. So you would say, well, why would I choose the high cap over the cap? Well, if the S&P returns 20, you got 14.5%. You get 30% of the 14.5, and that takes you to 18.85, which is just under 19%. These are phenomenal returns. We built a better mousetrap. We built a product that can give clients real excitement, real tremendous upside potential, and still have that downside protection. The last story that I love about this is our high par account. So all our accounts, all our index options are annual segments. They're one-year segments. They're point to point, right? And they're all based on the S&P other than the Hang Seng. Now the high par, instead of having 100% participation, it has 160% participation. So where the cap and the high cap you have 100%, meaning if the S&P returns 5, you get 5. With the high par, if the S&P returns 5, you get 160 of 5, which means you get 8. And then you get another 55% of the 8, which takes you to 13%. To me, that's mind-blowing. To be able to get a 5% S&P return and turn it into 13% is unbelievable. Again, the multipliers start in year 1. They're for the life of the contract, Bill, and they're all contractually guaranteed. They'll never be 54. They'll never be 56. It's exactly what's stated on this page. Okay, so let's take a look at some of the numbers now, and then we'll get into some of the concepts here. So whether you design this for 20 years of premium, 5 years of premium, 10 years of income, 20 years of income, our contract dominates. Other than Pac Life, we simply dominate the industry here. And this is highlighting the old product versus the new product. So for this male 45, 20 years of premium and then 20 years of income, showing essentially a flat 6%, which is how a lot of people illustrate, you'll see that our income and our targets among the highest in the industry. The only one that's even close is Pac Life, and we're 3% less with roughly the same target. Now, if we take the same client, instead of paying for 20 years, we want to pay for 5 years, same story. We're 164, Pac is 162. Outside of Pac, basically no one's even close. So what makes us stronger than Pac Life? We're going to get into it in a minute. It's not just the numbers, it's the whole story. Same client, we're going to pay 7 years, show 20 years of income. We're 177, Pac's 164, it's a 7% spread. And then outside of Pac, again, we completely dominate in terms of income. Here, we've got a 5-year premium payment. We've got a female, she's preferred. You'll see we're 315 of income. Again, Pac Life is 314. I think that's a typo. And then essentially Pac Life is even further behind. There's for females, you'll see the trend slightly different. What we've noticed overall, it's been a male-dominated sale and a male-dominated market. But for females, we are extremely competitive as well. Okay, in this design, Pac Life is slightly ahead of us, and I want to walk you through this. And this, I'm going to explain the difference between our product and Pac and help you position Hancock, I think, over Pac Life, even though in all fairness, the illustrations are fairly comparable. So in this case, we've got a male, super preferred, 55, and we're going to show 5 years of premium going in. We're going to show the max AG 49 returns, and we're going to show 20 years of income coming out of retirement. Pac was $112,000 a year in income. They were a $45,000 target. We were a $44,000 target, so roughly the same, but we were $105,000 of income. So we were 6% off. After us, again, there was a big gap in the rest of the field. You know, AIG was 20% more, Allianz, et cetera, et cetera. So let's take a look at this. Let's explain why illustrations, as I said earlier, just prove that ink sticks to paper. This shows you the charges in the contracts. So you'll see if we keep the contract for life, this is the same client, same situation, that Pac Life, their charges are 4 times greater than ours. Not double, not triple, 4 times greater than ours. And what's happening is because those charges are so excessive, I'm using that word on purpose, that if you can't get a strong return, if you're not getting at least a 5% or greater return, then it really impacts the performance of the policy, and the distance between John Hancock and us, even on the same design, gets greater and greater the more volatility and the less linear return you see. So for example, this shows you what happens when you have some volatility in the market. So if we show the max rates in all years, what we're showing is that we beat them if we use our max rates. But if we have a slow start, so we have 2 years of consecutive zeros, then you'll see the gap widens. We have 96 of income, they have 83. If we have a big fall where we have, instead of 2 consecutive zeros every 10 years, beginning immediately, this starts like beginning year 9, then you'll see the gap gets even bigger, 99 versus 86. If we have zeros, like a bumpy ride, 0 in year 1, and 8, and 11, and 18, etc., then it goes from 97 to 82. If we have cyclical zeros, if we have what we call the double hump camel, 2 consecutive zeros every 10 years, the spread gets bigger, bigger, and bigger. So we know, we discussed earlier, we're not going to get a linear 6% return. We know that's unrealistic, just will never happen. So we know we're going to have volatility in our performance. And the point being is that our contract, even if we don't win in every design, our contract essentially does, because we have less expenses and we perform much better in volatility. And again, we have multipliers that are guaranteed. Pac Life's multipliers are not. Their multipliers start in year 3. Our multipliers start in year 1. So what is the right index choice for your clients? What we love is we feel we've given you and your clients options based on their economic outlook. So for example, the S&P, if your client believes that it's going to return between 2 and 8%, then the high par is going to be the best place for them to put their money, because they're getting 160% participation, right? So that's where I told you a 5%, where in the capped account would be 5. In the high par account, it would be 13. If your clients believe that the S&P should return between 9 and 12, well, then the capped account with its 55% multiplier and slightly higher cap of 10.25, right, versus the high par of 8.5, will perform the best returns. You'll see 9 to 12 generally will return between 14 and 16%. And if they think the market's going to be really strong, 13% or more, then the high cap is the place to go, as that's going to generally give them 17 to 19% returns. And of course, you can reallocate every year, and you can allocate even within the same year among the different index options and choices. This is probably my favorite slide because I think it makes it really simple. It simply shows what I said earlier, that a 4% return in the capped account becomes 6, and our high par becomes 10, and so forth and so on. To be able to turn to your clients and say, I can eliminate tax on the growth and distribution of your money. I can give you a 4% S&P return, turn to 6, or turn it into 10, I think is very powerful. And I don't care what other investments your clients are interested in, this is going to get their attention and will rival anything else that they can invest outside of life insurance. We talked about fixed account rates. We don't have the same loads and charges as our competitors, and we have among the highest rate in the industry at 4.2%. The critical illness rider works very well with the LERP design. Again, you can add that rider. It has a very minimal drag, same with the LTC rider on cash value and performance. If you add a critical illness benefit rider, your target goes up substantially. It'll provide, again, a one-time lump sum income tax-free benefit up to $250,000. It helps protect your client's retirement savings. It pays the full amount within 30 days after diagnosis of a critical illness. That can be used, again, for anything. It can be used to pay for medical expenses. It can be used to go on a vacation. And it preserves the death benefit. It's the only rider of its kind in the industry that doesn't cannibalize the death benefit. You may have heard of other critical illness riders, but what happens is, at the worst time possible, you just had a heart attack, you have the option of losing your death benefit and getting cash. Well, you might not be insurable. Why would you want to give up your death benefit at that point? You bought it to protect your family, your loved ones, or you maintain your full death benefit. It's above and beyond. It's a very powerful technique. I'll tell you a quick story I just did. Let's just say, hypothetically, I'm working for Bill, which I am, and I'm Bill's superstar. I like to think I am. And God forbid I get sick. Well, instead of doing term insurance on me, if Bill's the business owner, maybe he'll do a permanent policy. Maybe he'll do the accumulation IUL contract where he can recoup his money or provide me supplemental income. But if I get sick, Bill, as the owner, can get the lump sum, and that allows him essentially to find a replacement, hire a temporary worker, help maintain the business while I recover. Because if you do get, unfortunately, diagnosed with a critical illness, the focus is on getting well. I don't care how dedicated you are. I work 80 hours a week, but focus is always first and foremost on your health, right? So we came out to this week with a brand new, what we call premium funding account. This is super cool. There are some other companies that offer this. We're excited now to be in the mix. So let's say you're selling my AIUL. You're part of this call. You're like, wow, this was pretty exciting. You call Bill up for some quotes and you say, I just came across a woman who just inherited $500,000. She's 45 years old. Her grandmother passed away. She inherited this money, wants to put it in a vehicle that's going to help her save for retirement. But she knows she's a little bit of a spender, and she wants to give the money now versus kind of hold on to it, because otherwise she's worried it's going to go to the wrong thing. So before we had a problem, because if she gave us the $500,000, it created a MEC. If it created a MEC, we lost all the tax advantages of why we would use an overfunded AIUL. So the premium funding account, the PFA, essentially allows us to take that money in and have the client earn 2.5%. It's almost like a John Hancock bank, and then systematically make those distributions between, over up to a 10-year period, thus avoiding it being a MEC, and that extra interest can be used to, either get a discount on your premium, generate more cash value, or enhance your death benefit. We're going to walk you through a few examples. This is hot off the press. This literally just came out this week. So, Bill, you're among the first people that are even hearing about this new option on our new index product. So, the interest rate is competitive and is contractually guaranteed. So, the current rate is 2.5% that we're going to be crediting on any money that comes to us for a premium for our premium funding account. Now, you'll see here the rate is super competitive to everyone else in the industry. Now, how it essentially works is it's going to provide you a competitive interest rate while the money is in the premium funding account. And it can be used, as I said, to pre-fund premium so that you get higher income potential, or it can be used in more advanced designs like for premium financing or legacy asset transfers. And the beauty is it's free of charge. I'm going to walk you through a few examples now so you guys can understand the power of it. So in this case, we have a male who's 45. He's going to do a 5 years of premium. He's going to do 20 years of income. By using the premium financing account, essentially, the total outlay is the same, but you'll notice the annual income and the target is higher. Well, why is the annual income higher? Because he's earning interest by using the premium funding account. He's earning interest at 2.5%. That income compounding is going to, that extra interest compounding is going to generate extra income. That extra income, when we run it, we can illustrate it, ended up buying a slightly higher death benefit. So we end up with the benefit of having a higher target, and by having more interest income, we essentially are getting more annual income. So what a great tool to enhance the performance of the contract. If we're going to look at a premium finance example, in this case, we're doing essentially the same thing, except we're using the money a little bit differently. In this case, instead of providing extra income, right, from the interest, we're going to basically use this to essentially reduce the loan. And we're going to talk about premium financing in a second right after this. But essentially, we're going to use that extra income, instead of paying less or instead of accumulating values more, we're going to use that interest to help repay the loan. By repaying down the loan, it provides us with a lower loan amount, and that's going to leave us with greater death benefit and greater cash value because we have to pull less from the policy to pay off the loan. So there's so many different ways that this rider can be used. In this idea for legacy transfer, we had a male who is 55, 10 years of premium. Total outlay, you'll see here, is the same, but the annual premium with the premium funding account is higher because we're going to actually use that interest to put more dollars into the contract. We can show more dollars going into the contract, which then produces, as you can see, greater cash value and greater death benefit. It's been increased candidly by over 12%. And again, a greater target because the greater income from the interest is creating a higher death benefit, which, of course, the target's related. So bottom line is the premium funding account can be used to get a discount for your client. So if the premium is $100,000 a year, they can maybe pay $97,000 a year because we can deduct the 2.5% guaranteed interest. We can instead have over $100,000 a year. We can show the same the same premium plus the interest. So you got more dollars going into the contract, which is what we've shown here. Or we can show that interest being used to accumulate more values within the contract, which can be used to enhance loan repayments for premium financing or greater income streams, et cetera, et cetera. We can show you it's super easy how to run, super easy how to design, and it gives your clients more flexibility, more options by avoiding a MEG and getting that guaranteed 2.5%. So it works super simple to lump sum payment into the premium funding account. The first annual premium moves from the premium funding account into the policy. Money in the premium funding account earns a guaranteed interest rate of 2.5%. And on each policy anniversary, John Hancock will transfer the annual premium from the premium financing account into the policy until the premium funding account has a balance of 0. So you tell us basically you want to move the money and have it distributed over 5 years, and it happens systematically every year until the 5-year period is over. So some of the guidelines: the premium must be level and annual. The minimum period is 3 years. The max is 10. So if you said, Andrew, we want to put in $1 million and have it distributed for 20 years, we couldn't. The max is 10. The minimum contribution is $5,000 plus the first annual premium, and the maximum is 10 times the annual premium. Unfortunately, LTC, accelerated benefit rider, disability payment, and life track are not available for the PFA. No policy changes are permitted when the PFA is elected. So that includes phase change, risk change, in which you're locked in during that time frame. There is an early termination fee. So if we're going to be crediting your clients 2.5%, and they decide, we're going to systematically, let's say, move money over a 5-year period, and they decide after the first year that they don't want, they're going to cancel, there'll be a termination fee of 5% in year 1, and it grades down slowly each year until it gets 0 by year 9. I don't think that's an issue. I think if clients are committing to do life insurance, and committed to do an overfunded IUL, because life insurance is so front-end loaded, I don't see a lot of clients looking to get out early. But if that's a possibility, you may want to avoid it, as there is a termination fee. And then, of course, interest earned on the PFA is taxable. So just approved, just came out. Right now, it is available in Florida, and you'll see the states will continue to update Levinson Associates, and specifically Bill, as to when and where this gets approved. But I think right now we have about 37 states where it's available in, and we're super excited to offer this. Okay, before we conclude, I'm going to give you a quick overview of premium financing. The product we talked about is great for supplemental retirement income. It's great for retirement backstop, even for older people who are concerned about living too long and having a health risk or inflation risk or a sequence of return risk where they might outlive their money, essentially. So we're using that product for people 35, people 75, but we're also using that product for premium financing. And it's super competitive. So this is just showing you our numbers compared to the other companies that are big into that space, and showing our older product. And you'll see our premium is right in there with everyone, and our cash value, if you look at year 14, which is around the rollout time of year, we are right in there with every company in terms of our premium to cash value and our targets. You'll see at 2.2 is among the highest. So we're a significant player in the premium finance space. Here's a typical design. So in this case, we had a male that was 50 years old. We're showing the max AG 49 for our capped account at 6.21, and we're doing a 7-pay. So long story short, we're paying $567 a year for 7 years, which comes out to just under $4 million. It comes out to $3,972,000. Rates have gone up. So the client in this example is going to be a simple design. They're going to pay the interest every year. So we borrow $567. That money is loaned to the trust. Because it's loaned to the trust, there's not subject to gift tax. The client then will be responsible for writing interest of $22,699. That money has to be gifted to the trust, which is no problem. It's a small number, and then gets paid back to the lender. And in this design, essentially what we're doing is we're overstuffing the contract as much as we can, avoiding a mess. And we're going to then use the policy cash value to repay the loan. So we're able to do that, and you'll see in red there in year 12, we have enough cash value where we can pull out exactly what we loaned, the $3.9 million, and we've paid $1.7 million in interest versus a $4 million premium. And you see the IRR at life expectancy at the age 88, 6.08%. It's equivalent to about a 10% gross return. Nothing to sneeze about. Pretty strong. And here's the supporting documentation that we have a nice presentation that Bill knows how to run and Levinson knows how to run, and we can support you as well on this. That kind of shows the loan amount, the interest rate, loan interest, actual loan interest paid, and the cumulative loan. And it goes on to talk also about the collateral. So this page you'll see here, it shows you the premium is $567, the estimated cash value. We have a spread comp rider. We're one of the few companies that can offer that, like, for example, PAC's PDX product is not. So their cash value is roughly going to be the same as what you're seeing here. we have the ability to turn that cash value from 200,000 to probably about making it up, but maybe like 480,000, which really limits your collateral. But this shows you the additional external collateral in the first year, the second year, because the cash value is so greatly increased, there's very minimal. And then you see by the third year, essentially, we can start reducing collateral. If you look at the far column in the middle, it says annual external collateral release. We can start taking back collateral, and then ultimately, I think it's after 6 years, there's no additional collateral at all. So the problem, though, with this design, which is what we're running a lot of, is that interest rates have really started to trend up. So you got to be a little more creative, and that's where Levinson comes in. That's where hopefully I come in. That's where my product comes in. So we'll see here from 14 till about the summer of 15, LIBOR has been relatively flat. As a matter of fact, it's been historical lows, and that's why finance business has really boomed. But you'll see in about July 2015, about the summer, interest rates started to spike. And the velocity and the uptick has been just huge in the past year. You'll see in the summer of 2017, the 12-month LIBOR was about 1.56. It's now 2.81. So because your starting point when you're borrowing has become so much higher, we got to be a little bit more creative. So the design that I just showed you, although it's valid and there's nothing wrong with it, generally that's not how we lead anymore when we do premium financing. So for example, this is how we actually reposition the case. And I'll show you two different designs that greatly reduce the outlay. Design one here, same premium, same client, but instead of rolling the loan out in year 12, we were able to roll the loan out in year 10. By saving 2 years of interest in the back, where the cumulative interest gets to be quite expensive, we were able to save almost $500,000. We reduced the cumulative interest from 1.7 down to 1.2, and because of that, you'll see the internal rate of return jumps from 6.08 to 7.39, which is now you're looking at close to a 12% pre-tax equivalent. Now, how do we do this? We use an index loan. An index loan, and I get into the product on purpose, we have two ways you can borrow money from an index contract, with ours at least. You can borrow through what's called a wash loan. We're going to charge you 2%, credit you 2%, so it's a wash loan. So the money you take out, we're going to charge you and credit you the same rate. So it's an interest-free wash loan. But then there's another way, which is called a participating or an index loan. And that way, we're going to charge you 4.25%. That's the current rate now. And that money is going to ride in the indexed account. And based on the performance of the index account, you could create an arbitrage where you're making money on the money that you're borrowing out. So for example, if we charge you 4.25%, right, and you keep your money in our capped account and the S&P returns 10, you got 10. Plus you got the multiplier, which is another 55%, so you got 15.5%. We charge you 4.25%, you just made 11% on your money. And by having that kind of arbitrage, you potentially, depending on, of course, on market performance, you'll be able to get out of this loan potentially in half the time. You can also use the index loan option as a way to generate more income. So when you see illustrations sometimes that show 100,000 of income, and then it's the same design, but it's showing all of a sudden 150,000 of income, and you're scratching your head saying, why did that income go up by 50% if everything's the same? It's because they're using an index loan. Now, the way we have designed our illustrations is we can't show more than a 1% spread. So in my example that I just gave you, we showed an 11% spread. And in reality, the client can get whatever the spread is. But from an illustrative standpoint, based on our interpretation of the NAIC rules, we can't show more than a 1% spread. Other companies don't take, their interpretation is slightly different. They'll include the 1% spread and their multipliers. We do not. We just include the 1% spread. We don't include our multipliers. But in reality, they will get the multipliers and obviously whatever the spread is. So when we ran this design, you'll see just very conservative, just showing the 1% spread, no multipliers. We were able to reduce 2 years. In reality, who knows? We could have maybe been able to pay this loan off if we had historical bull markets like we've had the past few years, maybe in 6 years, 7 years, 8 years. So this is one option that we're showing. Another option is partial interest. So this is one of my favorite sales because I think it makes it safer for the client. The index loans are very powerful and it can look phenomenal, but there's also more inherent risk because if the market should return zero that year, well, now you're getting charged 4.25%. This design, what I do a lot of times is I'll take a low cost premium, maybe a term premium, and I'll have the client pay a levelized interest. And so they'll pay maybe a little more in the early years, a lot less in the later years. And by doing that, I reduce the client's outlay, and we use the policy cash value. Remember, these policies are performed beautifully over any 10-year period, right? Any market cycle. It's well in the sixes. The high cap is returned well into the eights consistently, 10, 15, 20, 25, 30, 40-year look backs. And so in this design, you'll see clients paying the initial interest early, $24,000, $51.79. Then they're paying a levelized interest payment. That reduces the total interest drastically. It goes from 1.7 to 1.5. You save $200,000. It's I think a safer illustration. And then essentially, we still have a phenomenal IRR of 6.74. So levelized interest payments, partial interest payments, index loans to repay the loan back. These are all designs now that we are exploring and using in light of the fact that borrowing rates have gone up. 2 years ago, you could have borrowed money at 2.75% or 3%. Today, you're looking at around 4.5%. So that's causing us to be a little bit more creative in the finance designs. So the last thing I just want to say is that we do have very, very inexpensive, low-cost index products. And I'm showing this because, and this is my final slide, is that sometimes we make things complicated when it doesn't have to be. John Hancock has probably the least expensive, low-cost UL product in the industry. Our Protection IUL, the premium for $10 million is $122,000 for 10 years. So you can avoid premium financing, pay $1.2 million, which is as low as the more aggressive indexed option of repayment of the loan, right, that we showed earlier, and eliminate financing, eliminate having to pay a note back, eliminate having to come up with collateral, and just eliminate the entire mess. Now, financing has a place because maybe the client can only pay $50,000 a year, not $122,000. Maybe they don't have the liquidity right now. Maybe they're expecting a liquidation of a business, of a stock, an inheritance down the road, et cetera, et cetera. It also creates that arbitrage for people who like that or are comfortable working with leverage. But I just wanted to point out that we have very inexpensive products that sometimes you don't even need to do the premium financing in general. And the last comparison here is you'll see that if we look at traditional GUL, financing always looks super competitive because whenever you see financing, they always compare it to a GUL. Well, if you see like Lincoln GUL's premium is $300,000, where our product here is $122,000. So long story short, of course, paying 1.7 in interest is going to be a lot cheaper than paying $3 million in premium. But again, the reality is we have a very inexpensive product. You add vitality, it makes it less expensive. It goes from 137 to 122. As the agent, you make an extra 10%. You simplify the sale, get the case done, and don't even necessarily have to do anything with premium financing. So just want to throw that in there as an option as well. We already discussed the look-back period. And I think essentially, Bill, we're going to wrap it up at this point.
Yep, no, that was great. Great information. I know we went a little long, but that was well worth it. Like I was saying earlier with nuggets, that was a bunch of nuggets. So I know everyone walked away with some good information. Thank you very much, Andrew. Great stuff. Just real quick, we have about 2 minutes left, and then I'm going to let you go, I promise, even though we never like to go over an hour. I have some important stuff. If you want to see Andrew live, okay, we're having our Hancock meeting with Andrew Spiro at Maggiano's in Boca, okay? Very important on the top right there. We're going to talk about some new sales strategies, again, around IUL, premium finance, some other hooks and new information, 9:30 to 12, September 7th, okay? So if you're in South Florida, great opportunity. On the top left side, we're doing a similar meeting, same place, with Life of the Southwest, all about living benefits. That's on August 21st, so next week. Please try to attend that meeting as well. On the bottom there, if you're in the central or northern part of Florida, we are coming live on September 21st, right outside of Orlando. So what we're going to do there is kind of unique. We're going to present, of course, Levinson, and then Sagicor Life and Kansas City Life will be attending, all approved scholarship carriers. We would love for you to attend that breakfast meeting, 9:30 to 12. That's September 21st. All of these meetings are on our training calendar on the website. We'll also send out e-blasts for you as well. Joe's going to show you quickly some advanced marketing resources, some premium finance resources on our website so you know where to go for what, and then we'll close out the call. Joe?
Yeah, thanks, Bill. So real quick, on CarrieLevinson.com, underneath that product tab, you'll see there's a premium finance section. You'll see that arrow, all the resources and material regarding premium finance, questionnaires, guides, really presentations are all on that webpage, so you can access them 24/7. A lot of great resources. We will be emailing out a link to that page as soon as we upload the video and all the information this afternoon. Also, another great resource on CarrieLevinson.com is the advanced marketing page. You can access all the great material when it comes to premium financing. A lot of times we get into some more advanced conversations, and that's what this actual tab is designed for, is to help educate yourself and really have some great answers for that client. We talked about some great upcoming webinars and training sessions. Also, that agency automator platform that Bill mentioned, all trainings are held at 2 p.m. Eastern. We now have training Monday through Thursday on different parts of that automator platform. And then, of course, I know we mentioned this earlier, but in a week from now, we're having a complete demo on our Iul sales software and sales strategies. That's August 23rd at 2 p.m. Eastern. So some really, really great upcoming webinars to join. You can go right to the website and register for everything that we covered today.
Okay, good stuff, Joe. So thank you, everyone, for hanging in there. I know we ran a little bit over, but again, I hope it was well worth your time spent. We're going to end with this. That's actually a screenshot of the cover story. And the reason why, that's actually just a Positive Tuesday quote that we run on our social media pages, our Facebook, business, LinkedIn, Twitter pages. But it's so important because, you know, Levinson was built exactly around this philosophy, okay? And the reason why I feel so strongly about this, and I'm such a big believer, is because we did this day in, day out, making our cold calls, building one agent at a time, okay? And it's so relatable for any agent out there in the field. You get frustrated, you know, some of us are working out of let's say a 3rd bedroom or converted garage in their home in, you know, Midwestern part of the country, whatever it is, okay? The point is we can all make it happen. One day at a time, anything is possible. Put your right foot forward and make things happen. Put 100% effort in. We're here to help you every step of the way. With that said, have a wonderful rest of the week, a good weekend, and great selling. Take care.